Welcome back to Algobot, where we break down automated trading strategies for MetaTrader 5 in plain, practical language. I'm your host at Algobot, and today we're studying an expert advisor called Momentum Regime Continuation. This is a trend-following approach that only acts when trend direction, momentum, and acceleration all line up together. Over the next few minutes, you'll learn how it reads the market using a moving average, a rate of change momentum measure, and the average true range for risk. Everything here is educational information only, so let's dig into how this strategy thinks. So what exactly does momentum regime continuation do? At its core, this expert advisor is a trend-following momentum continuation system. Rather than trying to buy bottoms or sell tops, it aims to join a move that is already underway and stay with it while momentum persists. It can run on whatever symbol and time frame you attach it to, because it reads the primary chart's price data directly, whether that's a forex pair, an index, a metal, or another market your platform provides. Three tools do the heavy lifting. The first is an exponential moving average, or EMA, which defines the trend regime, simply put, which side of the market currently has control. The second is rate of change, a momentum measure that expresses how far price has moved over a set number of bars as a percentage. The third is the average true range, or ATR, which measures recent volatility and is used to size both the stop loss and the target, so that risk adapts to current market conditions rather than staying fixed. What makes this approach distinctive is its insistence on agreement. The strategy will not act on a single clue. It requires three independent confirmations to line up before it considers a trade, which is what helps it stay out of choppy, sideways conditions where false signals are common. Who might find a system like this interesting from a study perspective? Traders who are drawn to trend following and momentum ideas, who prefer clearly defined, rule-based entries and exits, and who want their risk framed around volatility rather than an arbitrary fixed distance. As always, remember that this is educational information only, not financial advice, and that every strategy, including this one, will experience losing trades along the way. Now let's walk through the mechanics step by step. The strategy operates on fully closed bars, and it makes its entry decision just once per closed bar. This means it ignores the noise of an unfinished candle and only judges completed price action, which keeps its signal stable. Every time a new bar closes, the strategy checks its three confirmations. For a long, or buy, setup, three things must all be true at once. First, the most recent close must be above the exponential moving average, so price is on the upside of the trend. Second, the moving average itself must be rising, measured by comparing its current value against its value 3 bars earlier. Third, the rate of change must be above its positive threshold, and the current rate of change reading must be greater than the reading 1 bar ago. That final piece is the acceleration check, and it confirms momentum is still expanding rather than fading. A short, or sell, setup is the exact mirror. Price must close below the moving average. The average must be sloping downward, the rate of change must be below its negative threshold, and momentum must be expanding to the downside. If neither a long nor a short setup is fully satisfied, the strategy simply does nothing and waits for the next bar. The strategy also allows only one open position per magic number at a time, so it never stacks trades on top of each other. When a valid setup appears and no position is open, it enters, buying at the ask price or selling at the bid. Risk is defined the instant a trade opens. The stop loss is placed at a distance of the ATR stop multiple times the average true range, which by default is 2 times ATR. The take profit is set further away, at that same stop distance multiplied by the reward to risk ratio, which defaults to 1.5. So for every unit of risk, the target seeks 1.5 units of reward. Finally, there is an optional ATR trailing stop. When enabled, it follows price at a set ATR distance, but it only ever moves in one direction, tightening to protect the position as the trade advances and never loosening. If the trailing multiple is set to 0, this feature is simply switched off. Together, these rules define a complete, disciplined plan for entry, management, and exit. Let's read the actual MetaTrader 5 code, the way it looks inside MetaEditor. At the top are the input parameters you can adjust. EmaPeriod, set to 50, controls the trend moving average. RocPeriod, set to 10, is the look back for the rate of change momentum measure, and RocThreshold at 0.15 is the level that momentum must exceed. AtrPeriod drives the average true range used for risk, while the ATR stop multiple of 2 and the reward ratio of 1.5 shape the stop distance and the target. The trailing multiple controls the optional trailing stop, and lot sets the fixed position size. Below the inputs are the two setup conditions. The long setup is true when close is above the current EMA. The current EMA is above the earlier EMA, meaning the average is rising, the rate of change is above the positive threshold, and the current reading is greater than the previous one. The short setup is the exact mirror. Price below a falling average, rate of change beneath the negative threshold, and momentum still expanding downward. When the long setup is satisfied, the code reads the ask price as the entry, sets the stop loss to average true range multiples below it, and places the take profit at that stop distance multiplied by the reward ratio above entry. Then it calls trade.buy with the chosen lot size. When the short setup is satisfied instead, the else branch mirrors everything. Entry at the bid, stop loss above, take profit below, and a call to trade.sell. Both sides share identical logic, simply flipped in direction. Let's bring the strategy to life with a chart. On screen, you can see a candlestick sequence with the exponential moving average drawn across the price, and below it a rate of change panel with two threshold lines, one at plus 0.15% and one at minus 0.15%. Watch how price, trend, and momentum work together. We begin on the left with a quiet, sideways stretch. The first few candles drift gently, price is hugging the moving average, and the rate of change line sits close to the zero line. Momentum is flat and the trend has no clear direction, so the strategy stays patient and takes no action. This waiting is deliberate because the approach is designed to sit out choppy, directionless conditions. Then something shifts. On the fourth candle, price pushes up and closes decisively above the moving average, and the average itself has begun to slope upward. At the same moment, look at the panel below. The rate of change line climbs above the upper threshold, and, crucially, it is higher than it was on the previous bar. That last detail is the acceleration check. Momentum is not just strong, it is still expanding. All three confirmations now agree: price above a rising average, momentum beyond the threshold, and acceleration building. This is where the buy entry marker appears. As the trade opens, the strategy immediately defines its risk. It places a protective stop below the entry, at a distance of 2 times the average true range, and projects a take-profit target using the reward-to-risk ratio of 1.5. You can see the stop marker sitting below the entry and the target marker projected above. From there, momentum carries the move. The 5th, 6th, and 7th candles print higher closes, the rate of change line stays elevated, and price marches up to the take-profit target, where the long trade closes at its planned reward. Notice we never had to predict the top. The strategy simply stayed with the established momentum until the target was reached. Now the character of the market changes. On the 8th and 9th candles, the advance stalls, the upper wicks grow, and the rate of change line rolls over back toward zero, showing momentum fading. The strategy has no open position now, so it watches and waits for the next clean setup. That setup arrives on the short side. By the 10th candle, price closes back below the moving average, and the average begins to roll lower. In the panel below, the rate of change line has dropped beneath the lower threshold at minus 0.15%, and it is lower than the prior bar, so downside momentum is expanding. The mirror image of our long conditions is now satisfied, and the sell entry marker appears. Just as before, risk is defined immediately. The stop is placed above the entry at 2 times the average true range, and the take-profit target is projected below at the same reward-to-risk distance. You can see the stop marker above the sell and the target beneath it. The final candles follow through. Price slides lower on the 11th and 12th bars. The rate of change line stays pinned below its threshold, and the move reaches the short take-profit target, closing the trade. Step back and notice the pattern. In both directions, the strategy did the same thing. It waited for trend, momentum, and acceleration to agree, entered in the direction of the established move, defined its risk with the average true range, and let the reward-to-risk target do the rest. It never tried to catch a reversal or guess a turning point. Of course, Not every signal behaves this cleanly, and losses are a normal part of any strategy. So treat this as an illustration of the logic, not a promise of results. And that brings us to the end of our look at momentum regime continuation. Today we unpacked how this expert advisor combines an exponential moving average for trend, rate of change for momentum and acceleration, and the average true range for volatility-based risk, all wrapped in a rule that demands 3 confirmations agree before a trade opens. We read through the code and illustrated both a long and a short example on the chart. Remember, everything in this video is educational information only, and it is not financial advice, a recommendation, or a solicitation to trade. If you found this breakdown helpful, please like the video, leave a comment with the strategy you'd like us to analyze next, and subscribe so you don't miss future MetaTrader 5 strategy studies. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.